Alrighty, let's get started. Good morning, everyone. Thanks for joining in on this wonderful Sunday. It's warming up a bit here in Calgary, so that's good. Just a couple of housekeeping things. I'm not an investment advisor. This is a kind of opinion on how I run my options. The basic terminology is, of course, what's kind of accepted by the general investing society. As the definitions. However, the valuation techniques that I use and kind of how I'm valuing these things is my own personal way of doing things. So please do your own due diligence. Options, just as a whole, are much more advanced than just owning the equities in a company that you're kind of invested in. Options can expire, which means you can't just hold them forever. Some of us who've been in the oil trade since kind of 2013, 2014, maybe earlier, you've held these stocks for years and years, and they've bounced back. Maybe you've been able to recover your money in them. That's not the case with options. Options will expire, and you will lose all the money potentially. Why options can be beneficial is that they give you huge leverage to the volatility that we see in oil. So if you're not comfortable with using margin and kind of getting margin called on some of your investments when using leverage, options are a great other way to kind of play it. They do give you a lot more upside potential, but they also magnify the downside potential. So just be aware of that. I have been getting a lot of questions about my options positioning, how I value these options, why I'm suddenly seem to have rotated into options in the last couple of months. So the biggest reason for that is that I always look for home run plays to be at least a part of my portfolio. If the macro outlook is really gonna pan out how I think it is, sometimes you're not happy with the percentage gains that you see in some of these oil equities. So, for those that kind of know me, in early 2021, my portfolio was 90% plus in Athabasca oil, given that I saw a 5 to 10x potential in that play. Going into 2022, I don't see many names with that sort of potential, unless we see oil price go kind of through the roof to all-time highs. So I started looking at margin, and again, margin is something that, the oil volatility can really kill you on margin. You can lose a lot of money on black swan events like the Thanksgiving kind of $10 drop in oil, etc. But options to me gave me a really, really good risk reward, and I'll kind of explain why here in the next few slides. It's a pretty short course. It's pretty basic. I'll go through kind of the basic terminology and then what I use to value two options that have been very, very profitable for me. One's a Crescent Point option, and then one's a Synovus option. And then I'll just kind of open the floor up to questions if there's anything, and kind of go from there. So this screenshot here is from TD. Your bank will have kind of a similar options chain, is what they call it. If you go to tmxmoney.com, on the Canadian side, you will have this information is freely available. And whichever broker you're with, you shouldn't have to pay any extra to get live options trading data. So we'll just go through some of the terminology here, kind of what you'll see if you open these with your own broker. So the expiry date is kind of the first most important thing, and almost the most important thing. So you'll see at the top here, it says expires Friday, September 16th, 2022. So if you don't exercise the option by September 16th, or you don't sell the option, the call option by then, it will expire on this day and you will be left with nothing. So that is basically the biggest downside risk to owning options. And to go back a bit, what an option does is basically what the word says. It's an option. So you're buying, so you're paying some money up front to make a deal with someone and say, hey, I don't really want to buy shares today. I want to buy shares 6 months from now, or 9 months from now, or a year from now. I don't really want to put in all this money, that whatever the share of ARC Resources is worth today. I don't have that money, or I don't want to put in that money today. I just want to buy the option to then buy the share by this date, by September 16th. So for you to buy that kind of option, you're going to have to pay some money to this person, because they're taking a risk that this stock could rise substantially by then, or fall substantially by then, depending on what option you're buying. So call option is basically a bullish option. You are bullish on the stock. You're hoping that it will rise, because what you do is you lock in the option to buy this stock 6 months from now, or a year from now, at today's price, or some sort of price that's close to today. So if the price of the stock rises, well, 6 months from now, you're buying ARC Resources shares at the price it was today. And if it's up 50% in that time frame, well, you're buying these shares much cheaper than you would be able to if you had just waited and kept cash and bought it at that time. So that's kind of a little bit of background on the options themselves. The expiry date is very important. That's the date you have to exercise the option or sell the option. So this option in particular for ARC Resources, you have until September 16th to decide what you want to do with it. Do you want to keep holding it? Do you want to sell the option if it gains in value, or do you want to exercise it? So to explain a little bit more about how that works, you have a strike price, and on any broker, you will have the option to buy a variety of strike prices that are below the share price and even above the share price. So this green line kind of represents where ARC Resources share price is currently, this dark green line. And there's options being sold below it and above it. So why is that? So the strike price is the price that you want to pay for the share of ARC on September 16th. So, if the price is here right now and you want to pay less for it 6 months from today, well, the person who's selling you this option is going to want a lot of cash up front, because you're trying to buy this share at much cheaper than it currently is. So they want a lot of money up front. However, if you want to buy the shares, higher than what it's trading right now, they'll sell it to you relatively cheaply. They'll give you this option relatively cheaply. So one of the examples that somebody used, I heard recently, was, maybe we'll get the point across a little easier, is if you look at your house. So let's say the house you're staying in right now is worth $500,000, and somebody comes up to you and they say, hey, I don't really want to buy this house from you today, but I want to buy it from you next January, and I'm ready to pay you $1 million for it. Or he wants the option to buy it for $1 million. He or she can choose to buy it or not buy it. So if you think in your head, okay, it's worth $500,000 today, this individual is offering me that they may buy it for $1 million. Well, I'll just give them the option for cheap, because it's so far away from the market price that they can just have this option, because in most cases they're not going to end up buying it for $1 million, because your house price is not suddenly going to double in a year, unless you're in Toronto and Vancouver, I guess, in some ways, over the last few years. But you'll give it to them for relatively cheap. But if your house is worth $500,000 today, and somebody comes up to you and says, hey, I want the option to buy this house for $400,000 next year, a year from now, you might say, okay, well, that's $100,000 below what the current price is. So in order for me to give them this option, I'm going to want at least that 100,000 plus probably a little bit more, because my house price is probably going to appreciate in the next year, with inflation there. And then just the fact that you as a seller of the option don't have control over whether the buyer exercises it or not. So you've lost this control on the money. So you might say, hey, I'll sell this option to you for $150,000. Just as an example. So anyway, the strike price is what you as a buyer is willing to pay on the expiry date. So the expiry date being September 16th in this case, what are you willing to pay for a share of ARC? And you'll see as the price you're willing to pay goes higher, the upfront money, which is called the option premium, decreases. So the higher price you're willing to pay, the more away from the current price it is, the less you have to give upfront. And that's true for almost every single option. Some of these options don't trade very often, so you'll see some mismatches maybe pop up, but in most cases that's generally true. One of the other risks again with options is liquidity. Unlike a share of ARC resources, which you can pretty much sell anytime you want for the current market price or maybe a cent below it, options don't trade very often. Like, if we look at this chart here, the volume on these options, most of them have no volume on the day, and they don't trade very often. If you want to sell your option, you might have to sell it below market price. So there we talk about the expiry date, the strike price, and then the option premium, which is kind of what you're paying upfront for it. So there's a question here on whether call options are available for all months in the future. So usually options will be available for the next 4 or 5 months from where we are today. So you will have a January option, February, March, April, May, and then probably a June as well. But then it'll go every quarter. So then you'll have a September option, you'll have a December option. And then once you're into the new year, it kind of restarts again. So you'll get a January 2023 option. You might get an April, kind of every quarter, and then every year we'll have an option. So you'll have a January 2022, 2023, and 2024. And that's kind of the max I've seen on the oil plays. If you're looking to do options on stocks like Apple and Microsoft, you have options expiring daily. So you can buy daily options. But I'm going to focus more on the oil plays kind of specifically, given that that's kind of the target market here. The bid ask is the same as buying stocks. So the bid is kind of what the highest bidder is willing to pay. The ask is what the lowest seller is willing to sell it for. So that's pretty consistent with stocks. And then the volume again is the same as stocks. The one difference is that when you buy options, when you buy one contract of options, you're actually buying 100 shares. So if you own one contract of a certain kind of option, you actually own 100 of them. So if you're buying one of this option, let's say, you're not paying $2.60. You're paying 100 times that. So you'll be paying $260 to own one of these contracts. So just keep that in mind. Sometimes if you're looking at people posting kind of their portfolio and their gain loss on options, you might get confused and think, okay, there's only 15 traded at $2.60. So, this person is only buying $40 worth of options. Well, it's actually 100 times that. So again, when you buy options, keep that in mind. You're buying 100 shares. One contract is 100 shares, and the price you pay will be 100 times what the bid is showing. Open interest is another one to kind of keep in mind. So open interest tells you how many options are currently outstanding on this contract. So of all the people that hold call options, how many are out there? And so that's important because for contracts like this, where there's only 10 options out there, you might have a lot of liquidity problem. If you buy these, you can buy options all day long at the ask price. But when you go and sell these options, you might have trouble. Like, this to me tells me, okay, the people are not really interested in this contract. So if I buy this contract, I'm basically making a deal to hold this contract, very close to September 16th, maybe a month before it. And, that money is basically going to be locked in unless I want to sell it for a huge loss or a, immaterial loss on it. On the other hand, some of these options, have more open interest. So I'm more comfortable buying these because I know that, okay, if I do end up in a situation where I have to sell this option to get some money, to get some liquidity, I will be able to sell it, potentially with not as much of a loss on it. So ARC has very low open interest. If you look at some of the Synovus options, CNRL, Suncor, you'll see the open interest is in the tens of thousands of contracts. So, naturally, those would be the options to own if you don't want to get locked in for a long, long time. So keep that in mind. Just because you think you're getting a good deal on an option, it may not end up being a good deal because you're effectively locking yourself into this contract for months, unless you want to sell at 10, 15, 20% below the market price on that option. And, speaking of that, when there is big market corrections in the oil market, such as Thanksgiving, again, I come back to that, the Black Thursday or the Black Friday, whatever, you can get really good deals on options. If you're watching them and if you're tracking certain kinds of options, people who are forced to sell these options at much lower prices than what they're worth or than what they want to, because they're getting margin called, because they need liquidity, they need cash, you can actually pick up very, very good deals on them. So there's a question here on, does low open interest mean low open interest at expiry? So no. And that's the point I'm trying to make, is that the closer the contract gets to expiry, the more activity you will see in the contract. So, you might have to wait until you get closer to expiry for you to find that liquidity in the option to kind of get out of it at a reasonable price. So, this example I have here is a September 16th option. So I actually hold these options. I hold I believe it's a $16 option on this. And I'm more than happy to wait until mid-August, late August to kind of realize what I'm trying to realize here. And, if you don't feel like waiting that long, well, there's options for January 21st and February 18th and March and April, May, etc. So, if you're looking for more of a shorter term play on that. The last terminology I'll go over is ITM, OTM. You'll see this kind of mentioned when people are talking about options. So ITM means in the money. So an in the money option is anything that has a strike price below the current share price. So, if you're making a contract to buy the share below what ARC currently trades at, you're basically buying an in the money option because your option is already trading, the share is already trading above what you're willing to pay for it. And then OTM, would be out of the money. So if you're willing to pay more for an option than the share is currently worth, you're buying out of the money options. Some people call it near the money as well, which I guess is a different term, but for the sake of ease, options are either in the money or they're out of the money. Are there any questions on this part of it so far? Either from Twitter or from the Zoom call. Okay, so there's a question here about if you're bullish on a stock, you would buy the out of the money option. So that's not entirely true. If you're bullish on a stock, you can buy any call option and you will make money if the stock does rise substantially or more than kind of more than normal in a way. And then the reason you would buy out of the money options is to get leverage. If you think the stock is going to rise substantially higher than where it is today, so for example, how Crescent Point has moved in the last 2 weeks, for example, how Vermilion has moved in the last month, if you see those kinds of moves potential, you want to buy more and more out of the money options because they will give you much higher leverage. They give you, up to 10, 20, 50x leverage is what you can get on some of these options that are well out of the money. So in general, if you're bullish on a stock, yeah, I would buy any call option is a bullish option. However, the more leverage you want, the more you think the stock is going to rise by the expiry date, the more out of the money option I would be comfortable purchasing. So, okay, there's a question here about volume is a concern on the TSX names. Correct. So if you follow the White Tundra portfolio, you'll notice that most of the options I buy are on the American side, because American option liquidity and activity is just much higher than Canadian names. So in general, I limit myself to the 5 or 6 companies that are dual listed for options. So you have Crescent Point, Vermilion, Cenovus, CNRL, Suncor are kind of the big 5 that I would hold, that are dual listed and give you kind of exposure to Canadian names on the US options market and give you that higher liquidity. The more people that are in those markets, the more open interest there is. ARC is the only option that I've bought on the Canadian side, just because I see a huge potential here, and ARC doesn't trade on the American side. So that's it on that. On the basic terminology, the other thing to mention is that the further out option you buy, the more time premium you pay. So with an option, what you're effectively paying for the share today is the strike price plus the option premium. So that's the effective price you're paying for the share. So, for example, ARC Resource today, I don't know what the price is, but I think it's around 12.25 Canadian. So if you buy the $8 strike, you're effectively paying 8 plus the 460 or the 485 here, depending on what you end up paying for it, for the share. So you're paying, if you're thinking about it, you're paying more than what you would today. And that's because you're buying time. You're basically buying the 6 months of time. And what is that worth to you to wait that 6 months to buy the share of ARC? And you'll notice the higher up you go in strikes, so let's say this $15 strike price, you're effectively paying 15 plus $1.15, so $16.15 for a share of ARC 6 months from today. So if ARC is at 12.25 today and you're paying 16.15, like you're paying 25% more for that share just to have the option to wait 6 months. And I'll kind of go through the examples here, and it'll explain why that could end up in your favor and why you would be willing to pay more for it, and kind of go from there. But if there's other questions on the basic terminology side, I'll move on to the examples. Cool. So this is an option that I bought. This is from my portfolio here. It's a Crescent Point call option for the 14th of April, and the strike price is $5. So I'm saying that I want to buy Crescent Point on the 14th of April for $5 US. So when I bought this option, Crescent Point was actually trading at roughly $5 US. So it was kind of a nice mix there, where instead of buying the share for $5 in, I believe I bought these options in December and then again in late December. So I thought to myself, okay, instead of buying shares of Crescent Point at $5 US at this time, I'm gonna make a deal with someone that I want to buy them on the 14th of April for $5. So why would I think that way? And this is where your understanding of the macro on oil is very, very important. My thinking is that by April 14th, the Omicron wave will be completely fizzled out globally. I believe that Crescent Point's Q4 results are going to be exceptional. Crescent Point is going to start paying the 18 cents a year dividend. So I think more and more dividend funds will start buying in. And I also believe that Kaybob Duvernay results are going to blow things out of the water. Like the numbers they're reporting, if they're true and if they can kind of keep them going, are very, very good. And potentially some of those Kaybob Duvernay results could be brought into the East Duvernay and kind of make that play a little more economic. So thinking about all that, I thought, okay, April is kind of a good time. The summer demand season kicks on. People are out of school and they go on their road trips, they go on grad trips. Families are planning their camping stuff, etc. It's a good time for this option. So I bought these options. I paid roughly 72 cents for them at the time, and we're sitting at roughly about a double on these options. And in the meantime, Crescent Point has moved from $5 to $6.17. So Crescent Point has gained roughly 23% in value. So if I would have bought the shares, I would have been up 23% on these shares, but my option is up 100%. So that's where the leverage can really come in. And the way I calculate these is here as below. So, I bought this option when Crescent Point was at $5 a share. And I run simulations on a bunch of stock prices that Crescent Point could be on the expiry date. So on the 14th April that I bought, what if the stock price is $4? So if the stock price is $4 and I bought the shares on cash, I would be down 20% because I bought the shares at $5. The share price now is $4, so I'm down 20%. If I bought these on margin, so margin gives me the margin on TD on Crescent Point allows me to buy double the shares of Crescent Point for the same amount of money. So basically, I'm doubling my leverage. So instead of 20% down, I would be 40% down on this share. The option would be 0. I would lose everything because the reasoning for that is that I have the option to buy a share of Crescent Point on 14th April for $5. If I can buy the share in the market for $4, the option is worthless because, it expires on 14th April. Let's say we're sitting on 14th April today. And, why would I exercise the option to buy a share of Crescent Point for $5 when I can go in the market and buy it for $4, right? So the option is worthless. So, okay, that's the downside risk you take. Now, what if Crescent Point doesn't move at all? What if Omicron is much more severe than expected, or blah blah blah, and Crescent Point is at $5 on April 14th? Well, my cash position would be flat, my margin position would be flat, but my option is still down 100%. And the reason for that is I can buy a share of Crescent Point for $5 in the market, and somebody can buy the option from me to buy the share in the market today for $5. So what is the value of that option? It's 0. If somebody can buy it in the market for the same price or buy the option from you to buy it for that price, it's worth 0. And I paid 70 cents for it in December. That's my time value that I paid for it to wait the 4 months. So again, if you're cash, you're laughing. You're saying, these stupid option holders, they think they know everything, and now they've lost all their money on this option, whereas you're sitting pretty, waiting for the summer travel boom to kick on and make some money on it. So okay, let's look at another price. So let's say Crescent Point closes at $5.72 on 14th April. On cash, you're up 14%. On margin, you're up double that because you're leveraged. You're up about 29%. And the option, you basically broke even on the option, because on this day, if Crescent Point is trading for $5.72, your option is worth 72 cents, because somebody can buy the option from you for 72 cents and they can go ahead and exercise it and buy a share of Crescent Point for $5. So they pay $5 and they pay the 72 cents to you, and then they can go and sell the share for $5.72. So effectively, somebody who would be buying the option from you would be breaking even, and thus you break even because you already own the option on that day. So, again, the cash holders are laughing, saying, this option guy thought he had everything figured out, and they didn't. You're sitting here with your gains. So now, let's say instead of 572, we have a very, very additional incremental gain to $6. So on cash, you made 20%, $6 divided by $5, you made 20%. On margin leverage, you made 40%. And the option actually makes 39%. And how do we calculate that? Well, on 14th April, if Crescent Point is trading at $6, your option is worth $1, because somebody can buy the option from you per $1, pay the $5 for the Crescent Point share, and then sell it for $6, right? And they would break even. So the option is worth 1, which is the difference. So 6 minus 5 is the difference. The actual price minus the strike price. That's what the option is worth on the day of expiry. So 6 minus 5, the option is worth $1, and you divide it by what you paid for it. So I paid 72 cents. It's now worth $1. I'm up 39%. So now the option holder is really having fun. You made the same money as a margin. You didn't take a risk on the margin calls or anything, and you're still sitting pretty here. Now let's say Crescent Point continues to go up and it goes to $7. Well, now on cash you're up 40%, on margin you're up 80%, but the option is actually up 178% because the option is now worth $2. So $2 divided by 72 cents gives you the 178% gain. And just to recap, the option is worth $2 because you can buy a share of Crescent Point for $5 on 14th April. And if Crescent Point is at $7, well, that incremental difference between the two, between the price of the option, or between the price of the share and between the price of your strike price, is $2. So, now the option holder is having the last laugh because, on the same price in the shares, you got more than 4 times the gain that the cash holder got. And, let's say there's a war in Ukraine or something goes crazy and Crescent Point hits $10 on 14th April. Well, cash, you're still happy with your 100% gain. Margin, you're still happy with your 500% gain, but the option is actually up 6x. So or a 7x. You have almost a 600% gain on this option on just a doubling of the stock, which if you've been invested in the oil and gas industry since kind of March 2020, I mean, these numbers that I'm throwing out here are not crazy and they've never happened. Some of these names, like even Synovus is up 600% on the equity, and Canada is up 20x. So a doubling of Crescent Point, if you want the leverage and you want these 5 baggers, these 10 baggers potential again, options are really the only way that I see to kind of take advantage of that. So that's the first valuation technique I use. Is if I'm certain that I want to buy a specific option with a specific strike price, I would look at where the stock could end up and kind of where my break evens are. So, if I'm comparing options to margin trading on CPG, I have to be confident that Crescent Point is going to be up at least to $6 based on the macro I'm seeing, based on the in-depth company valuation. So I have to be confident it's going to be at least $6 to kind of even consider options. And I was, because Crescent Point had been lagging. It'd been gotten beaten down. Shell was selling their shares and such. So I was pretty confident it would hit at least $6, and that's why I went with the option instead of buying too many shares and margin it or cash. Is there any questions on this valuation technique and kind of how I'm doing this? So yeah, Vic has a question here, a comment actually, which is my second valuation technique, which is the next slide here. So great foreshadowing on that. But I would use this method when there's a certain option I want to buy. If you look at Crescent Point options for the 14th of April, there's only one or two options that had the liquidity, that had the open interest that I was kind of really interested in. And so if I'm backed up against a wall on that and I can only buy a certain option, I would use this valuation technique to look at the comparisons between the different kind of prices that we could end up at. So are there any quick tools to easily see this option returns? Do the brokers provide this chart? So no, the brokers don't provide this chart, but what I'm doing is I'm building a option calculator right now in Excel. Hope to have it out in a couple of weeks, which will let you do all these calculations, and all you need to do is put in the current share price and kind of what option you're looking at, and then it will calculate all these things at different share prices and such for you, just to make it easy on people, because this does take some time to do yourself, and I think it would be easy for me to kind of build out something automated anyways. And yeah, so there is an options calculator online. It's an options profit calculator, which is very, very good. It's real time. It gets you the information you need. The only issue with it being is that I don't think it covers, what was the problem with it? There was an issue with it. I can't think of it right now, but I will kind of talk about that later. But for people who are interested in getting started on it right now, feel free to go ahead with this options profit calculator that's in the chat. A really, really good tool. I've used it a lot, and it gives you a lot of good information. Okay. So the other valuation tool I use is that if I have an option, so this is mostly for the American side. If I have an option that, okay, a lot of the options are have good open interest. A lot of the options have good liquidity. Then kind of what I would do is I would look at all the strike prices. Okay, which strike price gives me the best rate of return at the lowest risk? You're always trying to maximize your risk reward. That's always what we're trying to do. No matter what the situation is, we're always trying to maximize our risk reward on these options. So this is the Cenovus February 18th option. The reason I'm interested in this option is that for those that attended the Cenovus deep dive yesterday, you know that Cenovus has reached their net debt goal already, kind of, in the last couple of days. Cenovus is very active on the share buyback. And you know that what Cenovus said was that, if you believe them again, is that when they reach their $8 billion net debt target, the returns to shareholders will amplify. So I'm fully expecting that on the February 8th Q4 results for Cenovus, they will announce some sort of dividend increase. They will announce a accelerated share buyback even more, or they will announce that they bought back the Conoco shares, etc. And the market is going to react to that, as it did with Suncor's quarterly third quarter results, when the stock price shot up on a dividend increase and a share buyback plan. So that's February 8th. The February option that exists for Cenovus is a February 18th option. It's the only option out there for February, but it gives you about 10 days more than the quarterly results to kind of go through things and see how the market reacts. If they hike their dividend big time, you want to have an extra week or two to kind of wait for some of these funds to pile in, wait for some of these retired individuals who want the dividend income to kind of pile in. So it's a very, very attractive option for that case. If I'm playing oil volatility, if I'm playing oil stocks on the news, material news occurring, this option really stuck out to me. So I did the whole math on, okay, which strike do I want to buy? Which one gives me the highest leverage at kind of the best kind of returns, given that I only have 6 weeks and I can't expect the price to double in 6 weeks or even go up 50%. you're playing with time here. You don't have all the time in the world, unlike the Crescent Point option, which is April, or the ARC option, which I have September options, or like I have Suncor options that expire in January of 2024. I have all the time in the world to play around with those options, to wait for doubles or triples or quadruples in the share price. But if you're buying short-term options, be very careful of your expectations. You know, share prices don't move up immense amounts right away. There's a lot of volatility. There's a lot of other problems that can occur short term. So anyway, Cenovus, this is a strike price. This is the expiry date. This is the bid, and this is the ask at these strike prices. So on Friday, Cenovus closed at 1370 on the US side. Again, this is US options. So the other valuation technique you could see is, okay, which strike should I buy? If there's a lot of open interest, if there is a lot of volume in all the strikes, you have a lot of different plays you can play. So I look at all the strike prices from $9 to $18. You can even go less than this. And the math is pretty simple. You take the difference between the strike price and your projected share price on February 18th. So let's calculate the return if Cenovus actually goes down and ends up at $13 from $13.70 by February 18th. So let's say it's down. You take the difference between your strike price and the actual share price on that day, or the estimated share price. So $4, you subtract what you paid for the option. So that's your ask price here, $4.90. If you bought these options earlier at a different price, you put that different price in here, and then you divide it by, again, what you paid for it. So if Cenovus goes down roughly, you know, from 1370 to 13, that's roughly a 6% down move. You would lose 18% on the $9 option. On the $10 option, you lose 23%. The exact same math is used. So instead of 4 minus 490 over 490, we would go the difference between these. So 3 minus what you paid for it, 390. So 3 minus 390, you subtract them and then you divide it by 390 again. So, you know, feel free to check the math. If there's any errors in here, let me know. But basically it's the same math. You know, and the higher up you go in strike, the more you stand to lose. And, you know, at $13, you've lost everything. You've lost your entire option premium that you paid in only 6 weeks. So the downside risk is definitely there. With options, we have a tendency to be overconfident, and we think the shares are going to rise for sure because the XYZ is supply demand is looking like this, but volatility can kill you. So, you know, the Delta wave, for example, last summer, the Thanksgiving problem that occurred with oil dropping from 85 to 62, you know, these sorts of events can basically render your options worthless. So just be careful what you're playing and your risk tolerance with these, because it only takes a 6% down move in the price of Cenovus for your relatively safe option to go negative 100%. So let's say instead of this, Cenovus goes up to $15. So let's say it's up roughly, that's roughly 10% up, you know, which is pretty fair, I think. If you look at the move that Suncor had on the third quarter results, you know, a similar kind of move. So the $9 option makes you 22%. The exact same formula is used. Nothing changes. 22%, you know, and your gain kind of rises until the $12 option, and then you see this incremental loss from there onwards. And the reason for that, again, is leverage. The less money you put in and the higher your strike goes, the more leveraged you are, so the more return you make. But if the stock doesn't rise enough to kind of reach that strike price, you start getting diminishing returns and you end up actually losing money up to 100%. Like if you bought the $14 strike, you gained 18%. If you bought the $15 strike, you lost 100%. Like the difference between your decision making has to be absolutely pinpoint. You you can't just go into these willy-nilly picking random strike prices. Like you could gain 20%, 18%, or you could lose 100% by just one difference in the row. So, be very careful. Make sure you're deciding properly what you're buying, what strike you're buying, what expiry you're buying. This is not a thing to screw around with and go into, if you're buying oil equities and you just, you're willing to pay an extra 10 cents or 20 cents for a share of Cenovus or whatever, that's different. This is much different than that. You really have to be careful. And I cannot emphasize that enough. The difference between making a lot of money in options and losing everything is the finest of lines. And even the most advanced and experienced options traders kind of get caught up in this overconfidence of where they think the stock is going to end up. So me personally, I always like to play things a little bit safer than what I think is going to happen with the stock, because it's just confirmation bias. I think I'm bullish on oil, so I think all the stocks are going to go through the roof all the time. That's not how you want to be thinking when you're buying options. You want to be a little bit more careful, cool, calm, and collected. So I'll just give you my own full disclosure. I ended up buying this $12 option for February 18th. I bought it about 2 weeks ago, so it was a little bit cheaper than these prices here show, but it was this exact graph that kind of pushed me to the $12 option, where I have this 50% return. If I bought the $13 option, I don't lose very much, but if the stock ends up dropping for some reason, I can at least live to breathe another day here. Here, I'm completely out of the game on this option. And then on the upside, if Cenovus releases some sort of amazing quarterly result, they 5x their dividend or something crazy, and the stock shoots up to 17%. So that's roughly a 25% move from today until February 18th. Even your $9 option makes 63%. So on a 25% move in the share, your option made 63%. The $10 option makes 79%. The $12 option makes 150% return on a 25% move in the equity. And then it just keeps going up. The $15 option would make 344% return in just 6 weeks. And then again, look at this. The $16 option makes 233% return in 6 weeks. But if you were a little too confident and you bought the $17 option, your option expired worthless. You lost everything. So the difference between a 3.5 bagger and losing your shirt on this, losing everything you put in, is just $1 difference in the strike price. So, you want to be ballsy with these things so you can make more money. As you see here, my $12 option, if Cenovus goes to 17, is only going to make 150%. If I bought the $15 option, I could have made more than double that, 344%. But, I like to be on the safer side, and I kind of take my wins where I can get them. And, it's been working for me so far, fingers crossed. But yeah, these are the two methods. You use this method when you're forced into buying a certain option that has liquidity and volume. And I use this method when I have the option to buy a variety of different strike prices, and I kind of run the tables and I see what's my maximum downside I'm willing to take, and kind of where do I end up losing, getting diminishing returns with higher and higher risk profile kind of built into the stock. So yeah, that's kind of all I had for now. I'll post this presentation online as well for people who kind of want to go through them, run their own numbers. The options calculator that's mentioned in the chat, feel free to go through it, kind of play around with the numbers. Feel free to message me, Twitter, DM me if you have any questions. You're looking at a certain option and you're not clear as to how to do these calculations. I'm available. And if you want to know which options I own, look at the White Tundra website. It's there on the homepage. And I can kind of go through why I bought those by showing you the same table for those options at the time I bought them anyways. And then, yeah, I'll just open the floor up to questions. Um, so the first question here is, do I hold till expiry and then take the stock or sell the options for premium? So in most cases, when I run my calculations, I run them as if I'm going to hold the stock or hold the option to expiry, because that's just the way I like to hold these things, is that I want to realize the full potential of them. Now, if there's a huge spike in oil price and equities pricing at a certain time, and I think I can sell the option for a better return, I will sell the option. But the way I calculate them is assuming I'm going to hold, at least close to expiry, because that's what I found that I end up doing anyways. Given my mindset where it is and the way I've calculated it, I have a certain threshold that I'm looking to hit on these stocks. And, usually you don't hit them right off the bat. Usually it takes, 3 months or 6 months to hit some of these, gains that I'm looking for on some of these names. So if we go back to this Crescent Point option, I mean, it's up 50 or 100% already in the last, month or so. And, people are asking me, well, why aren't you selling this? Why aren't you selling this? It's a huge gain here. Well, I think CPG continues to go up, and I may very, very well be wrong on this, but I'm willing to take the chance that CPG continues to go up, for the reasons I mentioned on the Q4 results, et cetera, the KBOB, and I'm willing to hold on to it. And that's kind of been my mindset, is that once I look at the average, once I've done the calculations, my brain is kind of looking for a certain return on it and a certain share price to occur. And if that happens sooner than I predicted, well, I make even more gain, because there's a time value of the option that's still going to be reflected in the price. But in most cases, I've taken a loss. In my head, I've taken a loss on this time premium, and I'm just looking for the further gain I can get on it. So Vic is asking, do you have to have cash on hand to take the shares after expiry? Yes. If you wait till the option gets exercised, you have to have either the cash or the margin. But you know what? It's something I don't worry about, because the option has so much liquidity on the day that it expires that you can just sell the option. You don't need to worry about exercising the option and kind of having to pay the share price to take the actual share. You can just let the option expire, or not let the option expire. You can just sell the option on the day of expiry and close the contract, and kind of realize your gains that way. Why aren't out of the money options cheaper? It seems like far higher risk. Correct. The risk is much, much higher on out of the money options. Like, you're losing 100% on these options a lot of the time. So why aren't they more expensive, or why aren't they cheaper? It's because of this leverage. If you buy these in the money options, you would need an incredible change in the stock price to get these 300% returns or 200% returns. But if you buy these out of the money options, you can have much, much higher returns. The potential is there for these kinds of returns. And, if you think about it from that standpoint, if you make 4x on one of your options, you can afford to lose 100% on 3 other ones and still be in the plus. So a lot of people play these options like this. They're not worried about losing 100% as long as they can make 300%, 25, 30% of the time. So, that's just how people play these things. And the more leverage you get, the more leverage that somebody's willing to give you, the more risk that they're taking, that the stock price goes much, much higher, the more you have to pay up front for that option. Have you considered macro risk for Fed to announce more taper? Fed action sometimes beats fundamentals. So bang on, 100%. If the Fed raises rates, if they end up tapering their market buying, the market could have a crash here, and we could have these options go down. We could have equities go down, and I totally agree with you. And my answer to that is kind of what my belief on investing in oil is that if I'm investing in oil and if I'm going to spend 40, 50, 60 hours a week looking at fundamentals, following the market, looking at what's going on, I'm not in it to make, 10, 15, 20%. I'm here to hit home runs. And the only way you hit home runs is when you hold through volatility, you hold through potential black swan events, you hold through these things. I have to be in the market, I have to be in it to win it. So if I'm just taking my 5% or my 10% or even my 100% and backing out, it goes against the way that my investing is. And, again, I could 100% end up being totally wrong on this, and my crescent point option expires worthless on the 14th of April. But you know what? My investing history so far has showed me that, yeah, you take gains when you see these kind of risks on the horizon, but I just don't think it's going to happen. I don't think there's that much risk in the market as people are perceiving. And I'm fully ready to be wrong on that. And I have been wrong many, many times before. But I find that over the long term in the oil market, for me to make money, I have to be invested in these 50-50 events where I can either lose everything or I can make 5x or 3x or 4x. And if I go into these events in that way, in the long term, it's been a strategy that's worked out for me, whether it's a bear market or a bull market. So I'll just throw that out there. I'm by no means a genius, and I've had companies go bankrupt on me in 2014. I've had a couple of options, or one option that expired on me worthless. So, I've lost money, but on the long term, when you take everything in aggregate, this sort of strategy seems to be working for me so far. The next question is that for starters, is it better to think of buying options in a narrow range? 100%. If you're starting, you want to buy in the money options where your downside risk is more limited. You can kind of understand what's going on. You can do the math. You have some time to get familiar with things. You have a time to build up the mental toughness. The mental toughness is very underrated. For you to see some of your options expire worthless, it can put you in this loop of self-doubt and self-confidence problems. So, you want to be careful when you start with options. You don't want to go too crazy. Take your time, try to understand what you're buying, the math, how things kind of change as the stock price goes up or it goes down. So that would be my opinion. But again, I cannot offer investment advice. Please do your own due diligence, your own risk profile, and kind of what you see. There's a comment here on tapering will affect growth stocks more than value stocks. 100% agreed on that one. So, given that this is a resource commodity industry in an inflationary environment, I'm pretty comfortable holding these. How do you determine if prices have gotten ahead of themselves? So this is where you need to be very confident in your macro and your in-depth valuations. So my macro tells me that this is not the end for this energy crisis at all. And if you're looking for more information on that, please have a look at the recorded session from yesterday on the macro, and then the Synovus deep dive. So if I'm telling 80 people on Zoom yesterday that the macro says that oil price is going higher, the macro says that natural gas prices are going higher, and then I do a valuation on Synovus which shows that it's 50% undervalued, I have to have conviction in this name. I can't be selling it because I feel there's a pullback, because I just don't. I think the work I've done on the macro, the work I've done on the companies themselves, in my opinion, for my own risk tolerance, I'm happy to hold these options, for much further out. There's a comment on the Vermilion options. My Vermilion options are till December 2022, so I have the time to hold through any short-term tapering issues or Omicron concerns and such. And then by the time December 2022 comes about, I have a target in mind that I want this kind of return from this option, and that's kind of what I'm looking for. And for people that know me personally, I guess I don't play safe. I'm looking for home runs, and if I can hit 3 home runs and have 10 misses, I'm still ending up ahead. So that's just the way that I invest. And this time I see that the macro and the valuations are kind of in my favor, and the risk reward is looking good. So for my own risk tolerance, my own investment strategy, that's the way I do things. For other people, if your option is up 50%, it might be a good idea to sell, but I can't make that decision for you. It's whatever you're comfortable with on your own way. There's a comment here on warrants are better for beginners. So Synovus does have a warrant that expires in 2026. And that's a great point. If you want to just get used to kind of how these options / warrants move with the underlying price, that is a good play. You can buy these options, you can buy the warrants and you can kind of track it over time. You can look at the Synovus option or warrant history and kind of see how it's moved with the share price, to give you a little more understanding of these long dated options. Oh yeah, that's the other thing. Options don't get dividends. If you own options, you will not get dividends. So for high dividend paying entities like Suncor and CNRL, for example, or Enbridge maybe, keep in mind that dividend that they give out comes out of the stock price and you don't get it. So you will not get that dividend payment. So, for entities that pay huge dividends, you might want to be careful again with your expectations and understand that you're not getting the dividend. So that also opens an opportunity because you can buy options right after the dividend kind of came out, and you might be able to find yourself a mispricing on a certain strike at a certain expiry date. If you keep your eye out, it's an opportunity. You look for opportunities where you can find them on options, because if you can save 10 cents or 15 cents on your buy price, the leverage you get, 5, 7, 10x leverage on that, the return can be much different on it. Any opinions to covering calls? So 2 weeks from today, I'm going to talk about an intro to put options, and then 2 weeks from that, I'm going to talk about some very advanced strategies with options and holding equities and options at the same time and such. But I don't want to talk about them now, given that this is just an introduction course to call options. But as people get more familiar, as they attend more of these options sessions, about a month from now, I'll be talking about more advanced strategies with all these options. Do I buy leaps on the underlying commodity? I don't trade oil options. I don't buy crude oil or gas options. I just don't understand them enough, and I'm really not interested in playing the financial market. I like playing the actual equity market, which is more predictable, whereas the oil options can go out of whack completely. Such as the whole Cushing negative thing, the whole WCS diff blowout, etc. I'm not interested in trying to track all that stuff as well. P. Burry here says that 2023-24 options are far more safe. Completely agree, but again, they don't offer you the same leverage. Far out of the money options on 2024 are still commanding a pretty significant premium. So, you're having to put that money up front to get that time value. So again, if you want to play safe, yes, you want to buy these longer dated options. But I think for my own scenario, I think 6 to 9 to 12 months out is still a pretty safe bet and gives me more reward potential than some of these far out of the money long dated options. That being said, you will see that I own Suncor options for 2024 and some other names as well. So again, I can't give you a one size fits all answer to that. It's your own risk tolerance, your own due diligence. Can you find a deal somewhere? Can you find liquidity in these 2024 options? And I would bet that a lot of them are totally illiquid. So, go from there. The other question I have here is about charting and technical analysis. So I only look at fundamentals. I do have people that send me charts on the 68% Fibonacci and the head and shoulders and stuff, and I do look at that. I do kind of keep it in the back of my mind, but my personal opinion is that for commodity trading, for oil equity trading, charting and analysis is just not that valuable of a tool. Fundamentals will always, in most cases, if the EIA report comes out with a certain draw, it will end up having more of an impact. Inventory, supply and demand will have more of an impact in the short to medium term than charting. I do agree that charting and technical analysis and the way that traders trade, the delta hedging, the gamma hedging does have an impact on these equities. I just don't think the time that I would put into researching that and kind of putting into that would correspond with any greater returns than if I spent more time on the macro, the fundamentals, and the in-depth valuations on certain companies, on options pricing, etc. If there's a stock on which one is strongly bearish, so if you're bearish on a stock, you should be buying put options, not call options. And I will discuss that 2 weeks from today, same time, Sunday, on put options and when they can be used. So there's a comment here about the people who make money are the ones that write the option. Yeah, correct. So the people that are getting the money right away are the ones that are writing the option. Agreed. And for stocks like Apple, Microsoft, Google, if you want to play the roulette machine and you want to buy day options, if you want to buy week options, you by all means go ahead. You can maybe make money on them. I just don't care for it. I think there's better money to be made on these long-term options. But anyway, that's just kind of my strategy on it. Be careful with options. It's kind of how I'll end this. Be very careful with options. Don't buy something that you're not willing to stomach the expiry date and it expiring worthless on that date. And for me, the long-term options, the ones that are kind of in the money, close to the money, are kind of the ones that I play, and I feel very comfortable investing in them. But if you're buying options willy-nilly, if you're just buying random stuff, the people who are writing the options will be the ones that end up making money off you. So yeah, just be careful. And I think one of the comments here earlier that talked about if you're new to options, should you be buying some of the in the money options? I would heavily agree with that. Your downside risk is a lot less on them, while still maintaining more upside than the equity itself can offer you. So yeah, I guess there's no more questions, so I'll leave it at that, and I'll end the recording. And thanks again for joining in. My DMs are always open. If there's any questions further to this, and feel free to message me on anything else. And we'll see you in 2 weeks for the intro to put options, and kind of go from there.
Hey, Shubham, would you like to let them know that we're going to be having a reserve discussion about reserves right after this, if they're more than willing to join us if they'd like?